everyone, and welcome to Trading the Trend. I am Rachel Dashiell, your host just for today for this webcast and Senior Manager of Trading Services here at Schwab. I am joined in the chat by Kevin Horner. He is my buddy there. He is going to be helping us out in the chat. So please feel free to chat in your questions, comments, requests during the session today. Please also give us a follow on X. He is Kevin Horner CS. I am Rachel-CS. We both post tons of charts and technical analysis, so give us a follow there, and please like and subscribe to us here on Trader Talk Schwab Coaching, like this video. Now today, I know we've seen maybe some bends in the trend as of recent, and we know trading is a probabilities game, so we're going to talk about building a framework for knowing when those probabilities may be shifting, and we're going to talk through building a weight of the evidence approach today. But before we get started, let's hop into some important disclosures here. So options carry a high level of risk and are not suitable for all investors. The information that we're going to cover is for general informational and educational purposes only, should not be considered any type of recommendation or advice. And we are going to cover the paper money software application, place a couple example trades on those. Keep in mind that there are some major differences between paper money and live. Now, as far as our agenda for today, we're going to start with our market overview. We're going to talk technical analysis and identifying trends. We're going to talk about trends in multiple time frames and look at examples on the charts. So let's dive in here because we have a lot to cover today. Let's talk about what's going on with the major market indices, because we have had quite the move today. Something that we're looking at here, if we just look at what happened today, we can see that we lost that crucial 200-day simple moving average. The last time we traded below that was back in May and April. We used that as support a little bit in May as well, but ever since, we've been trading quite a distance above it until recently. Now, the next line in the sand for crucial support for long-term investors is really going to be this horizontal line right here that we've seen, that's been really drawing this line in the sand right around 65.50 or so. So that's going to be that next level there. We're seeing a similar breakdown in the NASDAQ composite as well, but again, still hanging on there right at horizontal support, which is really that last line of defense there. If we lose this horizontal support right around 21,850 or so, we may be looking a little bit further down near 20,900 where my mouse is down there. So quite a bit more to go there on the downside. Another development that I saw kind of stacking up today looks like it is in the 10-year yields actually. Noticing a little bit of this inverse head and shoulders action here, with the left shoulder really occurring in January. We got the head down here in February, March. We have this little right shoulder that got carved out with that bullish engulfing candlestick right at that 200-day. And we see that price is trying to battle with that neckline here today. I thought this was a fun one to bring for you guys, just because if we take a look at that measured move, that puts us right at this area of resistance. So I guess fun for a technician, not so fun for the overall market here and what the implications of this could be if this does play out. So again, patterns are not guarantees, but just wanted to show what we're kind of seeing there in the market today before we really hop into our discussion. Now, the trend trading, obviously a huge discussion today. We're going to look at the trend over multiple time frames, but we're also going to take a look at the current market environment and a lot of different signals that will help us discern the trend a little bit more by also defining the regime that we're currently in. So I think this will help just kind of give us an example framework of how we can take all these different signals that we're getting in the market and really apply this weight of the evidence approach to see what type of environment we're in, whether we're in bullish alignment, whether we're getting a little bit more of mixed evidence, or whether we're in bearish alignment here. So we know as traders, when we have an alignment across time frames, an alignment across a regime, we have higher probabilities for our trades. So essentially that's what we're going to go through today. So let me put my notes up on the screen so you guys can either jot this down or take a screenshot of it, a picture of it, whatever you would like to do here. But we're going to focus on not making our framework based on opinions. We're not building our framework for trading on the headlines, but again, focusing on this weight of the evidence approach. So we're going to look at these 5 different pillars of the weight of the evidence. We're going to look at the trend. So we're going to start with the S&P 500, and we're going to take a look at where we are at for the 50, the 200, and our structural long-term support. And you guys kind of already saw on the chart there, we are not above the 50-day moving average. So we're going to put that one in red there. We also just lost the 200-day like we just saw as well. So that's again going to be another almost like bearish tilt here. So I'm going to make those in red. I'm going to put our mixed evidence in yellow, and I'm going to put our bullish evidence in green. So we can kind of weight all of these things today. Now, we did also talk about how the S&P 500 is holding this structural support as of now, right around 65.50. So that's really the line in the sand that we're looking at. So since we are still holding that as far as the overall trend, we're going to make that one green here. Okay. Now, the next step that we're going to look at, the second pillar for really just applying this weight of the evidence approach, is looking at market breadth, because we know it's not just the stock market, it's a market of stocks. So we need to be able to look underneath the surface, see what this market of stocks, 500 plus stocks, according to the S&P, is doing here in this case. So what we're going to take a look at next is going to be market breadth, and that's going to tell us a little bit more about what this market of stocks is doing, where we're sitting as far as stocks being above the 200-day moving average, percentage of stocks above the 50-day moving average, and then we're going to dial down into just looking at the list of New York Stock Exchange new yearly highs, new yearly lows, because that will kind of tell us the market environment that we're in as well. So I'm going to pull up a different grid here for this one. You guys have seen this one before. Kevin and I have talked about this one on Trader Talks quite a few times. I know you've probably seen it in other webcasts as well, but essentially this kind of gives us that picture of what we're seeing and where these percentages have been really over the last year as far as market breadth. So if we really start at the top here, the longer term trend, we can see that we have less than 50% of stocks above the 200-day moving average. So we came off some of the highest levels all year as far as those breadth signals, and now we're kind of getting into some of the lowest levels we've really seen since last June. So that would be notable for a lot of traders, especially those who are trying to find long-term bullish opportunities in this type of market environment. So if we kind of look here, that is one that we can mark off as red on our list, because we have less than 50% of stocks below the 200-day moving average. So I'm going to pull that back up here again. We're going to check that one off the list, give it a little red color there, and let's look at the 50-day moving average. So Now, if we're looking at stocks, percentage of stocks above the 50-day moving average, these are just S&P 500 stocks, we can see we are hitting some of the lowest levels that we have seen since we had that pretty strong sell-off back around the tariff tantrums back in April. So getting to some of those lowest levels, even lower than what we saw in November during a minor pullback, minor correction there. So that one is noticeable as well. Again, well below the 50% level as there. So we're going to pull this back up, check that off on our list, give it a little red color there. And then lastly, let's look at those New York Stock Exchange new highs and new lows. Now we can see the new highs list from where breadth was sitting at some of the highest levels on some of these other indicators. We saw the new high list. We had most stocks making new highs, and we've had quite a bit of a drop down since there, and we're kind of at some of the lowest levels that we've been all year. So not a lot of stocks making new highs. We do have 67 stocks making new highs, but we can just kind of use this as a measure of saying, okay, in a strong bear market, or strong bull market, I should say, we are going to have more stocks reaching new yearly highs, okay? Now, in a weak bull market, or possibly a bear market, we're going to have more stocks making new yearly lows. So kind of at those lowest levels that we've seen. And if we just draw a line maybe from, let's just look from where we are now. We're going to draw a line here. We can see that new yearly lows have gotten to this level multiple times here. So we're kind of reaching some of those same levels that we've seen throughout February and March. So maybe like a little bit of this stealth correction that we're seeing under the surface even before the S&P started to slide off a little bit, even before the trend started to bend. We saw that rotation happening under the surface. We're seeing that stocks are making more new yearly lows there. So some of the highest levels that we have seen really again since November during that correction, we're not yet getting a huge spike like what we saw back in April, which is typically what you're going to see in larger corrections. So for a lot of traders, they want to watch this list here, but it is slowly expanding. It is slowly churning up. So we're going to put that as a mark here on our list here. And we're just going to give that a little yellow sign here. Let's do this so you guys can still see it. That's going to be yellow. I know it's a little orange, but it's going to be yellow. So that's kind of like our warning sign here. We have new highs contracting. We have new lows starting to expand. We're not seeing a very meaningful expansion of those new lows yet, so keep that in mind. And I will share this script if you guys, oh, Kevin, you already beat me to it, buddy. Thank you so much for sharing that for me. So he shared the script for you guys. Those are not guaranteed for accuracy or timing, but this is what we have used kind of as that teaching moment for just being able to quickly gauge some of those signals of market breadth and the health of the market of stocks. So we've made our way through the two first pillars there on our weight of the evidence approach. Let's get into momentum, because when we're looking at trends, we want to see if our trend has momentum or if momentum's waning a little bit or is a little bit more weak, because that gives us a signal that tells us there may be a possible change in the trend. And so what we're going to use in this case is actually looking at the RSI, the relative strength index. And a lot of you may use this, a lot of traders may use this for looking at overbought and oversold conditions. But the other way that a lot of traders use this is defining the momentum regime that we're in. And the way that you can do this is actually by just plotting a line. We're kind of going to do this here. We're going to plot a line right at the 50 level here. Okay, so we're going to plot that line there and we can see what's going on here. So when we are in a bullish momentum regime, now I want you to take a look at this time frame that we have all the way from where we kind of made our recovery in April all the way to, let's say here, back in November. Notice that the entire time that this stock was making an uptrend, we had momentum staying consistently above 50. So when the RSI is above 50, this tells us that we are not reaching near oversold levels. Even with pullbacks, momentum is still remaining strong above 50, which is that midline there between the two. And that's really telling us the momentum regime that we're in. So for most of the year, I guess the first half of this past year, we have been in a bullish momentum regime. Now that seemed to change quite a bit. We saw a few different momentum divergences here, where we saw slowing momentum. Let me kind of use this, where we saw that price was breaking out to new highs, yet the RSI was kind of making lower highs there. And then really ever since, I mean, just over the past month or so, we have seen RSI making lower lows with price, staying down near here in more of a bearish type of regime just in the short term. So keep an eye on that. That is not really confirming with signs of an uptrend and things like that. Again, we have those structural levels that we are looking at, but we know momentum has been waning. So again, that's going to be a little bit of a red flag for us when we look at the momentum regime that we are currently in. Still not hitting those oversold levels yet. We're still not even seeing a bullish divergence to give us an indication to the downside that this potential downtrend could be slowing. So those are all kind of things that we want to keep in mind here on this one. So we're going to make that a little bit more of a red flag there on momentum there. Okay. So, yes, and Kevin makes a really good point. So I know we're not talking too much about the overbought, oversold signals on the RSI, but keep in mind those do persist because you're typically going to see in an uptrend, you're typically going to see RSI. It may stay in overbought conditions for quite some time. I mean, we saw this really back in July and August, where it stayed nearly overbought for a month of time. And then there's been times where markets have remained oversold for quite some time. So what you're going to be looking for is those divergences to possibly give you a signal that momentum may be shifting a little bit, but obviously it comes back to the overall trend. So keep that in mind. Okay. Now, let's take a look at the next part of our 5 pillars, and that's going to be our risk regime here. So this is kind of like our cross asset work that we're going to discuss. And one of the things that traders tend to look at is they may look at the bond market and they may see if there's signs of weakness in credit, because typically credit markets, bond markets tend to crack a little bit before the stock market. So one of the things that traders may look at is they may look at the spreads between high yield bonds and treasuries, and they may see if those spreads are widening or tightening out. And because it's really just, they're looking for that extra compensation for taking on default risk, liquidity risk, economic risk, credit downgrade risk. So keep in mind that may be something to kind of look at there. Now, spreads get wider between these two when investors get nervous, when recession risks rises, when default risk increases, or when liquidity tightens. So that's typically a signal for traders that there may be some cracks under the surface, maybe some cracks in credit there where you may get a little bit more volatility. Now, those spreads tend to narrow when risk appetite tends to increase, your earnings outlooks improve, and financial conditions tend to ease. So that may be one of those there. We're just going to put that as a little bit more of a yellow flag in this case on this one. Now, as far as high beta outperforming low volatility, if we look at just kind of high beta stocks, well, what is beta? The market has a beta of 1. You're going to have more volatile stocks, more aggressive stocks with a larger beta than 1, a lot more of those slow growers with a beta of less than 1. So high beta stocks need liquidity, they need strong growth expectations, and they're going to be groups like more of like the risk on groups or cyclical groups like technology, consumer discretionary. You're going to have financials there, you're going to have small caps, so they need that growth. Now, low volatility stocks are more of those cash flow machines. So these are going to be more of the defensive type of stocks, more of like the utilities, the staples, the healthcare, and those tend to perform best when investors prioritize stability over returns in this case. So we're also going to put this as a little bit more of a yellow flag, looking at just what high beta stocks have recently done just in the near term and low volatility stocks have done. Because obviously we've seen that weakness on a relative and absolute basis in financials, in tech, in discretionary. We're seeing a little bit more of the strength in some of those more defensive groups as well. And then lastly, consumer discretionary, that's cyclical, outperforming its staples, consumer staples group, which is obviously more defensive. That one is also kind of in the same area there as far as just being a little bit more of a yellow flag. And I can show you a chart on that one as well, just taking a comparison of the two. Discretionary in the numerator, staples in the denominator, making a ratio here. We saw this top formation and we've had the breakdown in this, which is really showing that staples over the long term has been outperforming discretionary. We're having a little bit of a consolidation now, which is why I'm putting that as more of a little bit of a yellow flag on that one. Okay. So let's go into the last one, which is sentiment or fear. So you want to keep an eye on this one, and I want to talk about this one as well, because typically with sentiment, we kind of want to figure out if we're seeing more panic or more fear, because fear in an uptrend is more of an opportunity. Fear in a downtrend is a little bit more of instability in this case. So we want to see if sentiment is more one-sided. We want to see if there is panic in the market and things like that. So let's just take a look at the VIX. We're just going to use that as our example today. And we're going to take a look at what the VIX has been doing. So typically in periods of panic, well, I guess in periods of higher volatility, you're going to see the VIX above 20. That's kind of like 19 to 20. That's kind of like the long-term average for the VIX volatility index. This is just a synthetic option of the most liquid at the money S&P 500 options with at least 8 days to expiration. It's going to obviously increase when you have more option buying activity. It's going to increase when you have times of panic in the market. Right now, the VIX is trading above its 50-day, above its 200-day. And if you look at the VIX down here, what did we just say about momentum regimes? Well, ever since the beginning of really 2026, the VIX has been in a bullish regime here. So we've seen that there has been a little bit more heightened fear in the market. There is not yet sheer panic. There was a little bit of panic here on March 9th where we saw the VIX went above 30 there, which typically signals more of that panic indicator. But again, we are still having just a little bit more fear in the market, but not necessarily the panic. So Let's keep that in mind as well. So I'm going to put this on our checklist. We're going to make this still a green flag here, since we don't have crazy panic in the market. We just have a little bit of bearish, quite a bit of bearish sentiment here, just with all of the things there as well. And I see Paul, he put in, yep, CNN fear and greed index at 16, at that level of extreme fear. Obviously, we need to know if you are using that as your sentiment or fear gauge, if you're building a weight of the evidence approach. Needing to know what goes into building that type of indicator is definitely really important. I know other traders may use like the AAII, like Investors Intelligence, survey results there to look at levels of historical optimism, pessimism. So whatever you're using as these metrics, just keep in mind that you're knowing what goes into actually building a gauge like that. And of course, this is not, of course, a recommendation. This again is just a framework where you can take kind of some of these pillars and maybe build your own framework, your own weight of the evidence approach as you define the regime that we're in. So again, we're doing this because we want to make sure we're in alignment with our trends, with the current market environment we're in. So if we take a look here, not a lot of green on the screen. We have more red and more yellow. So it's kind of giving us this mixed evidence type of scenario. So we kind of talked about three different environments. We have the first environment as this bullish alignment. That's where you're going to have a majority of green signals. So a lot of green signals there, little to no red. That's going to be more of an environment where we're going to see momentum or RSI above 50. We're going to be seeing that we're going to be seeing higher highs, higher lows, the S&P 500 trading above its moving averages. We're going to be in an environment where breadth is expanding. So that's more of like this tailwind type of regime. So that's environment one, our bullish alignment. And so when we're in that bullish environment, typically we can buy pullbacks on the trend. We can trade breakout continuations. Those types of trades or environments favor high beta type of trades, aggressive growth trades, and it allows trades like some room to develop there. So that's the type of environment where we're going to want to buy on pullbacks. We're going to want to add size. We're going to want to trade those breakouts, aggressive breakouts there. Now, more of the environment two, more of the mixed type of environment, the environment that we may be seeing now, just using this as an example framework for a weight of the evidence. This is where we have some signals that are bullish, some are deteriorating, and this is where we see that traders tend to get a little bit more chopped up. So if you're getting a little bit more chopped up in this environment, this is what we can do as far as traders in this type of market environment where we're getting this mixed evidence when we apply the weight. A couple of different things that traders can do to be a little bit more successful in an environment like this. One, it would be to reduce position size. Another would be to take profits a little bit quicker, a little bit sooner. Focus a little bit more on relative strength. So look for those areas that do have relative strength compared to a benchmark or compared to other groups, or maybe more of those stocks that have those have strength and are showing relative strength in various sectors that are already outperforming the overall market or some of those weaker sectors. Another thing we can do in this environment as traders is to avoid aggressive breakout chasing, and also just remembering that it's probably not the time for oversized, outsized convictions and things like that. So managing our position size a lot more, which is again like what we always talk about in this class. But we may want to reduce that even more in this one. I know a couple of you guys, I know Gary mentioned, yeah, he's chopped. Okay. Yeah. I've heard that from traders, some of them getting chopped out of trades. I've honestly seen it a little bit myself too, because I'm a trader myself, and I'm going to admit I sometimes make mistakes. I sometimes get chopped up. I know Kevin would probably say the same thing as well. It's something we can all relate to, but these are kind of some habits that we can do in this type of environment where we are getting chopped up. Now, in the third type of environment, now if we start to see our weight of the evidence tilt even more towards bearish type of signals, bearish type of evidence, when we have a lot of red on the screen, that is really when we're going to see breadth contracting aggressively. We're going to see a downtrend or a true bend in the trend, a break of the trend. RSI below 50. This is kind of more the environment where traders are going to sell more of those rips into resistance. They're going to focus on more of those weaker sectors, maybe tighten those risk controls there, some things like that. So keep in mind, just your job as a trader is alignment. So that's why we discuss trading over multiple time frames, having a plan, having this checklist to weight some of the evidence there. And it's just essentially because trends don't necessarily end when they're extended. They end when participation really deteriorates, when you run out of buyers, when you run out of sellers at those various levels. But if you measure some of the evidence, you're a little bit more prepared to not predict, but to react more to the price action that you're seeing, which is what we're doing today. So any questions on this today? And yeah, I see Kevin in the chat. He's like, yep, it is a difficult market. Don't mistake us for perfect traders, because we all make mistakes too. We all have to refine our process, and that's what it honestly comes from the best teaching moments. And that's kind of why I brought this today, because I noticed in a couple of my trades recently, I had been getting chopped up, and I thought this would be a good thing to discuss and what we can do in those types of environments as traders. So our mistakes become our opportunities for growth. So if you guys want to take a picture of this, screenshot it, whatever, you guys can obviously watch this recording back if you didn't have time to write all this down. Certainly build your own framework as well. But now kind of taking some of the things that we just discussed about the type of environment that we're in, we're going to focus on with these example trades, having a little bit more of a smaller position size. We're going to focus on stocks that have relative strength, and we're going to focus on taking profits a little bit quicker, avoiding more of those like aggressive breakouts. So I'm going to change the chart a little bit here. I'm going to hide the 200. I'm going to show, I'm going to hide the RSI as well on this one. And we're going to go with an example one here on Coinbase. So we can see Coinbase, if we just look at the short-term trend, I drew this trend line just to easily see that. From the lows in February, we've been making higher highs, which we can see here, and then higher lows. Okay, so that short-term uptrend is intact. Now, we do have a bit of confluence today. A confluence of both mostly support, but essentially we have a confluence at this uptrend line, so this ascending trend line that we're seeing. We're also seeing this range really taking shape with horizontal support really occurring at that level. We're running into a little bit of resistance at the 50-day, and again, support underneath at the 20-day. So if we're looking at this as part of a short-term consolidation with maybe an ongoing short-term uptrend, something we may want to do with Coinbase, which keep in mind, be aware of the risks with just cryptocurrencies and things like that, that have a little bit of a different value. So keep in mind with those there. We're going to look at relative strength versus, let's say, Bitcoin in this case. So we're going to look for relative strength, use that as a proxy, use that as a benchmark, and we can see as the trend has been moving up, we've seen some strength and relative strength against the benchmark with Bitcoin here. So that was one of the things we talked about we're going to focus on in this type of environment. Another one is we're not going to take aggressive trades. So with this one, we're going to take a little bit more of a neutral trade a little bit more of this range that we're seeing here, and maybe just do more of a time-based, more of a volatility-based type of setup. So what I'm going to look at, since this is just over a very short term, we're going to look very short term with this trade, and we're going to trade an iron condor. So where may we look in an iron condor to say, hey, we want price to stay within a certain range? We may look for a strike to the upside or resistance to the upside around 215 or so, support to the downside, probably right below 190, maybe even 185 here on the downside. So that's what we're going to look at here. Now, if I go to the trade tab here, I'm actually going to look at the weeklies with 36 days to expiration. The only reason why I'm choosing this one is because the monthlies have, on the upside for the calls, they don't have 5 increment spreads. They only have 10 increment spreads. So I wanted to have a balanced iron condor here. But for this one, we're going to look at 36 days out till expiration. Keep in mind, we have that time decay that occurs on options. Really, that curve really kicks into high gear where theta tends to expand even more. Time decay gets greater and greater close to expiration, typically at that 30 to 40 day mark as far as expiration. So when we're a seller of an option, that works in our favor there. So let's build an iron condor using those support and resistance levels that we saw on that shorter term chart. So we're going to look here, buy the 170. Actually, we're going to go buy the 180. Sell the 170, or sell the 185, sorry. Okay, yeah, buy the 180, sell the 185, because that was just below support there. So that's if we're seeing a $10 move to the downside, still gives us a little bit of cushion. If you look at the delta there on our short strike, that's telling us that may be obviously $1 move in the stock. That's telling us how much our option's going to move. Also a little bit of a probability as well. With the smaller delta, you're going to have a larger probability of that option expiring out of the money, which is what we essentially want with this trade. Now to the upside, what did we say we were looking at? Was it 210? 215 or so. Okay, 215 on that case to the upside. So if we look at the 215, we're going to go 215, 220 there on this one. So if we take a look at this iron condor, I'm going to right click on it and analyze this trade here. Okay. Oops. Okay, and if we look at this on the option chain, we can just kind of take a look and see. We're going to make this the day after our expiration, which is there. Okay. So essentially what we're looking at is we are looking at a max gain of what we can collect in our credit, which is $330 right there. And our downside of how much we can lose on this potential trade is really going to be 170. So it's going to be essentially the difference between those strikes minus that credit that we are bringing in. Now, you'll notice here with this probability range here, this is going to show us that shaded activity telling us that this is our probability of this option. Or I guess this is essentially just showing us a 1 standard deviation move. So if you, of the stock between now and expiration, so if you want a little bit higher probabilities, you could widen out your short strikes a little bit more. So you could just essentially maybe do the 180 on the downside and maybe the 220 on the upside and just kind of widen those sides out a little bit. But essentially what we're just using, we're looking at those deltas, looking at a little bit more of that smaller probabilities, a little bit less movement in the stock. We're also using some of these pretty firm levels that we've seen that Coinbase has traded in over the last couple weeks. So this is the trade that we're going to put on in this case. We are just going to do one contract here on this one. Again, keeping the position size pretty small in this case. We're going to hit confirm and send on this one. And again, you can see our max profit, max loss. Obviously, the other picture gave us a little bit more of a visual look, and we are going to hit send in this case. Now we have a position. Okay. Now we have only just a couple minutes left in this case. So I did want to show a couple other stocks that are in trending environments, kind of fit the picture that we talked about before, where you have RSI in a bullish regime, you have relative strength within that name, and you do have more of a little bit of a bounce, a little bit of a breakout. But these may be stocks that traders may say, hey, we may wait for a little bit more confirmation at these levels before starting a new trade, adding size, things like that. So in this case, we're going to look at AAOI, and I'm going to take out this, put on our period moving average here. Okay, AAII, obviously been a strong leader, has been using this 20 period moving average as support in this ongoing uptrend. We did have a couple touches of support here, and today we are having this possible bullish engulfing. Most traders would say, hey, I want to wait to see a confirmed bounce to see if we close above the high of this low day tomorrow on that next move to really give us a confirmed bounce. So that would kind of be that hold level, that confirmed bounce level to see a close above the high of that low day on that bullish engulfing. BTU would be another one. We had a little bit of a break on this type of formation here. It was a little cup and a little handle, and then price made its way to new yearly highs here on this one. Traders may, since price, it's not really closing above that level, traders may wait on this breakout trade to not be too aggressive on this one and maybe wait for a couple closes or a percentage move beyond that as far as breakouts, because we talked about this type of environment being a little bit more cautious on breakout trades there. And then another one for you guys here, VG was another one that we saw. We had a little bit of a break today. This morning it showed a gap up above that resistance level, and ever since it has closed that gap on this one. This one has also remained above its 50 and quite very much so that's 20 period moving average as well, using that as support. But again, it's not holding that breakout. So keep that in mind as traders in this type of environment. When you are trading breakouts, traders may wait for a little bit more confirmation at these levels. So I know that was a ton of information today, but we know that, like I said, our job as traders is looking for alignment, not just across time frames, but in the market regime that we are in. So we're having a plan, we're having our checklist, we're using this as just a way to be a little bit more cautious in the current market environment that we are trading when we are trading the trend. So I want to thank you all for all your engagement in the chat today. I want to also thank Kevin Horner for helping us out in the chat. Please feel free to follow us on X. I am Rachel CS. He is Kevin Horner CS. If you like this video, please smash that like button and please subscribe to us on Trader Talk Schwab Coaching on YouTube. Thank you, everyone, and have a good rest of your week.